back in 2020, Freddie Mac said we were short about 3.8 million housing units. It was causing a housing crisis in the United States, which we are living through today. Well, Freddie Mac came out with an update to that number, and we are still short 3.7 million housing units. So while we see incredible movements, and some folks we'd see declines in single family home sales and pricing, and why aren't we going to see higher vacancy rates with all this supply coming online in multifamily? Well, this is just a part of that answer. And today on the Gray Report, we're going to be digging in again into the fundamentals of the multifamily market, looking at where we are, where we've been, and trying to get a good picture of what 2025 in the next couple of years might look like for multifamily and commercial real estate. We've got a great slate of data and reports to go over that Dr. Matt Bosnagel has put together. So if you're a multifamily investor, active, passive, you're going to want to watch this full episode, make sure you subscribe to the Gray Capital YouTube channel. You like this video, and leave a comment below that we'll get back to you with. All right, a lot of great reports. Again, RealPage, Freddie Mac, Fannie Mae, NAR, and TREP. Let's get into it. Back on the report, Matt, how's it going this week?
Pretty good.
Happy early Thanksgiving.
Oh, thank you. You too. By the time this comes out, it will have already been Thanksgiving. So
everyone's digesting.
Yeah.
Hope we're getting the Christmas holiday season in full effect with Thanksgiving coming a little bit later this year.
True.
But part of that, Matt, we're starting to get 2025 forecasts, more data coming out, some more images of how the third quarter really progressed with some good analysis. And today on the report, you've got some really good reports and articles that give us a little bit of a better picture on just the status of the U.S. housing market, everything from supply, interest rates, economic landscape, existing home sales. We're going to be talking about, migration trends from NAR, and then digging into this potential wave of loan maturities that we talked about on last week's episode. I'm about a piece from TREP entitled Multifamily Investing, Navigating Risks as Maturities Loom. So a lot of factors kind of coming into focus for 2025, a couple of themes, and a lot of it is, the fundamentals, I think, are going to push this market forward, and to the surprise of some, but we're still so far away from, clear blue skies and, no issues at all, that we still have a lot of bumps in the road and some real obstacles to navigate, and probably some pain for investors and owners to come throughout 2025. So, before maybe we get into jumping into supply on this RealPage piece, Matt, I like to ask you a lot of times, just because you're just getting off like putting, this report together, and we've got the newsletter that you can subscribe for that's going to come out on Thursday morning. So, right before Thanksgiving, and read about what's going on multifamily. Sign up at graycapitalllc.com. But just the synthesis, Matt, put all these articles, put these reports together. What's your baseline? What are your thoughts? How are you feeling about multifamily right now, and then going into 2025?
I think that there still is not enough supply.
Waving in your face.
I think that rent growth is not exactly going to take off instantly. I think we're still going to be it'll be the waning effects of this wave of new apartment supply that is paradoxically still not enough to solve the housing supply problems. Whether we're talking single family or multifamily, there is a housing shortage that you noted right at the top. But rent growth is still, I think that we're still kind of dealing with a little bit of the hangover from 2021, huge rent growth, and the market's still adjusting. We may it's at a much more kind of mature point than it was in like at the start of 2023 when this cool down started.
So wages still need to pick up a little bit, even though wage growth is still relatively strong. I think the last metric was wages are growing by about 4%, which is more than rents, but rents increase by a much larger magnitude. So most likely subdued rent growth in 2025. I don't know if we're making a call specifically. I know we've got our own 2025 forecast that's going to be coming out soon. What about prices? We saw a decline, kind of 15 to 30%, depending on kind of what type of deal it was, what market it's in, how it's performed, how if you overpay, some folks overpaid. There's been some stability. We saw interest rates, the 10-year Treasury, come down to the mid threes. Now we're up into the mid fours. Yeah. Obviously, we don't have the crystal ball on all of the interest rates and when, but just what are your thoughts in terms of price appreciation, price declines for 2025?
I think it's hard to see price declines now. I could be wrong. I'm here saying that rent growth may not be the crazy 5-10%. It may be closer to 2 or 3. But appreciation seems a little bit more locked in terms of, like, we're talking about the investor sentiment, really even consumer sentiment. Yeah. People are in a lot better mood about the economy. And I'd like to think that probably extends to the investment market. And also, there just is a lot of pent up demand from investors, and a lot of potential deals that could be coming into the market. Now, the deals coming to the market could mean that prices go down, but I think that there's going to be some greater activity that facilitates hopefully some appreciation, only based on these kind of long-term expectations. We're not saying that the Fed funds rate is going to fall really quickly, and we've seen the 10-year kind of hover very relatively high as well. But like, if we extend this now, a lot may depend on like this tariffs that we keep hearing about, and maybe inflation. But I'm not really taking tariffs that seriously. I'm going to tell you that.
I think we're going to have to wait and see. And it's a good point because, even on this Fannie Mae piece, that is really well detailed, kind of well cited, going through a lot of their methodology. They have not incorporated an updated forecast
I saw that.
to incorporate the election. Yeah, they say, and a lot of folks are, just because they're not really sure how to forecast it, because even though I think Trump came out and posted some thoughts for tariffs with China and Mexico yesterday, I think most of the market, big. Well, I think most of the market is seeing it as just negotiation strategy,
that's what I see
and
too.
not the actual number that's going to be incorporated, which that has economic effect, because people start making moves and readjusting supply chains. But it's very hard to quantify. And the only analysis that I've seen really done on anyone trying to incorporate it is very, round numbers, basically saying, what's being proposed, let's just cut it in half. So we don't really know. Yep. And it's given a lot of level of uncertainty, which I think is going to be a theme and could create some opportunities, because I think certainly the media and investors, I think, are over-focusing on certain aspects and forecasts on how the economy is going to go, and taking everything so literally. And there'll probably be some malinvestments, over-allocation, misallocation, and just overweighting certain things to the extreme, when it's probably going to be somewhere much more in the middle. But because of that, we're not. The reality is, we're already starting to see the economic landscape change, in a way, whether it's domestically or internationally. We just don't know how all of that is going to play out. But I'm definitely bullish on the United States right now. I think we're probably going to see more foreign investment into U.S. commercial real estate. It kind of dropped off over the pandemic. Maybe that leads to increased investment into U.S. Treasuries, which will in effect lower some of those long run rates, which will be interesting and counterbalance some of the higher growth and potential higher inflation because of the tariffs. I'm a free trade, anti-tariff kind of guy, but it's just going to be interesting to see it play out. And again, we can't, as an investor, we can try to understand those things, but we can't really worry about them. We can't really control any of those variables. And so, focusing on the things that we do know, and that we, and then taking action where we can't control, which markets we're going to go into, what is those long-term fundamentals. And starting with supply. Because one thing we've learned is supply is critical.
And just and just to put a pin on this
Yeah.
whole kind of discussion about whether property prices are going to increase for multifamily investors or not. I think they are only if you just look at the long-term trends. We were at the bottom of this kind of U-shaped CRE recovery. It started in 2023. We sat down at at the bottom, really low activity, and it's starting to pick up.
Yeah.
So it looks a lot like the same as it did like a couple of years ago, but we're on the other side of it, is what I would argue. And the length of this and these longer term trends in investment activity are persuasive enough, even apart from like the economic condition. You just see people are getting into it again.
It's so true, and it's a lazy form of analysis, but I don't think it's wrong. Not what you said, but but what sometimes Jay and I will be talking about, and we'll look at a deal and cash flow in the first year or two, with lower growth assumptions in the first 12 to 18 months. It's like on paper, given some relative conservative assumption, it doesn't look that exciting.
Yeah.
But one thing that we're overly confident about is it's going to be worth a lot more in a couple of years.
Yeah.
The exact path to get there is less certain, but given the long-term fundamentals and intuition, just what we're seeing in the market, it's like it's going to be hugely successful. We know we're not going to lose money. We'll probably make a lot of money, but can we get excited about the first couple of years of lower cash flow? Because we're probably not going to be able to buy it for a price this low, and so but it doesn't necessarily match the return profile that you would have seen with more consistent growth. Where it's like, we know that we're going to get at least 3% organic rent growth this year, probably, or 2.5% rather than maybe we get 1% or 2% this year, and then because you're compounding after that, it's hard to know when you're going to see that spike of 5, 6, 7% in a given year that often happens after negative years or decline or slow down. You see kind of a housing crunch. Because a lot of equity will look at that, and you don't necessarily have a particular set of data to say, we're going to get a 7% rent bump in year 3. It's kind of it's seen as kind of random. Although I think there's a lot of there is evidence, and actually that's what we're working on. We were talking about it beforehand. Is we're going to be doing a lot more work on doing a lot of our own just rent growth modeling for submarkets instead of just kind of assuming a similar trend. And ultimately, like, I think that some of the uncertainty that we have about the economy, and which extends kind of to the CRE market, is it's related to the election. I think that people are uncertain, but I have a feeling that those clouds will clear up pretty soon. Even though, despite the whatever view of the 2016 Trump presidency was, it wasn't like hugely economic chaos all the time. So I'd like to think that there's going to be some kind of set expectations and some rules that we can follow, and we'll know in the future. And that's going to clarify pretty quickly, because I don't think he wasn't throwing things out of whack all the time, every time. So if you
it's just impossible.
If you ignore some of the chaos, keep your head down, just keep making good deals that make sense. I think you're going to do really well, like folks that did in the last Trump administration. I think if you focus on the chaos, you're going to get diverted and distracted. To be honest. All right, Real Page. Great piece on supply 2025 apartment supply. Leaders ranked by market, and just starting. Then I'm going to pass over to Matt. Calendar year 2025, more than 500,000 apartment units are expected to deliver across the United States. They're saying that while supply delays might curb that figure somewhat, it's safe to say it will be another year of high supply in most major markets nationwide. That's
that's one of the things that is tempering any kind of rent growth perspective. I want to call out the regional variations here in apartment supply. I'd hasten to say that's like the lesson here. And you look at this map here of markets expecting the most new apartment supply in 2025, and you see outside of Denver how it's like a U shape. Bring back the U shape here. We got Seattle. It's all on there's a little bit of West Coast. There's the South, and then there's East East Coast. There is a nary an inland market to be seen here among these markets expecting the most new apartment supply in 2025, except Denver as that outlier. Another big feature is it's mostly in the South, much more the South than the North. And when we're talking about percentage of supply, I would argue that the Sunbelt markets are getting a higher, on average, percentage of supply growth. And if you're talking about raw numbers, you've got New York at the top, but that's like in a category by itself. So and I was kind of looking conversely then at the markets that are expecting kind of the least new apartment supply. And I had to go to CoStar for that information. And the median, by the way, is 2.9% apartment supply growth. So but the lowest supply growing is actually New Orleans, which has in the past year, supply has only grown by 0.29%. Now, when you're talking about like the amount of future construction, it's a little bit different, but it is notable that New Orleans, isn't really building a whole lot now. It hasn't built in the past. It's got under construction apartments only 1.7 of current inventory compared to a median of 3.1. Really, there's just New Orleans is an interesting market, and then you've got Providence, Rhode Island at second at 0.69. But again, on average, people built 2.9%. That's how much supply has grown on average for these markets. And then like you've got like the larger markets, you'll see a smaller percentage, but here's another one. DFW, notably, this is according to CoStar numbers, they really breaks the mold here. It's a huge market, but it also grew its inventory a whopping 4.63%. And then it's got 4.4% of inventory under construction. That's huge numbers for a huge market. And like there's a lot of variables that are going to make these numbers different for RealPage and CoStar, especially just like where they draw the line for the city and what kind of units that they're counting as multifamily and not. But you get a real good idea here that these markets are a lot of them are in the Sun Belt. They're not all waterfront cities or anything like that, but they're clearly kind of clustered around the coasts a little bit and in the South. And kind of to go back to the RealPage article, they say that several smaller markets are expected to grow total inventory by more prolific ratios. Like Asheville will grow by 13.3%. Maybe they need those houses. And Huntsville, Fort Myers, Savannah, Myrtle Beach, they're all expected to grow inventory more than 7% in 2025. All but one of the 150 largest apartment markets are set to receive some new supply, with Youngstown, Ohio as the lone exception. Again, like if looking at these Sun Belts, it's hard to really understate the mismatch of supply. So you're looking at one, New Orleans is 0.3. Indianapolis is expected to grow around 4%. The average is 2.9. And some of these, Miami is set to add 12.3%. If all the apartments get built that they're building right now,
under construction,
12.3 is, and then Durham, 11.6, Charlotte, 10.8.
Yeah.
It's a song we've sung before, the Sunbelt song. It's like it has lured, this is really a theme here. It has lured investors and developers with this like Pied Piper influence. And I wonder if it lured too many of them down there, they built a little too much. Sunbelt is more promising in terms of population growth, and maybe job prospects, but it's easier to overbuild than it is to bring the people.
We were talking earlier, it's like the .com bubble.
Yeah.
You weren't wrong for investing in the internet, in the late 90s.
Yeah.
I know that was the right move. You're definitely going in the right direction, but sometimes, you can pay too much. It can be a flooded market, and you can invest in sometimes the wrong assets, in a given market also. I think what we're going to hear more about, when these upcoming loan maturities and some of the distress that we will see over the next year, it's going to be relatively isolated to, some deals that were bought for way too high of a price.
Yeah.
They were over levered, and they're probably older properties that need a lot of deferred maintenance, a lot of capex, and the insurance premiums have probably ballooned as well.
Yeah.
And so you could have been in the right markets and the right. It's much harder to pick some of those winners and losers.
Yeah.
And when it's a rising tide environment like it was over the last cycle, you could take a broader approach, but we're seeing we're seeing the difference between kind of the right markets and the ones that are pretty well exposed right now.
Yeah. It reminds me of some of these older from a couple years ago Berkadia articles about how like there's kind of positive volatility and negative volatility, but some of these volatile markets there's upswings and downswings, and you have to have a long enough time horizon so that all the upswings stack those up and not be caught on the wrong side of it, for sure.
Yeah, absolutely. All right, let's move on. Let's keep talking about fundamentals. Freddie Mac put out this really nice piece. It's going to be on the newsletter. So graycapitalllc.com. You can sign up for the Gray Report newsletter, which is you're going to be in good company for the folks that are getting the newsletter. Some of the top minds in multifamily commercial real estate. We look at what companies they work for, and it's all the heavy hitters.
When you hear the siren song calling you maybe to a Sunbelt investment, you may be more informed and say, hey, that looks good because the fundamentals look good. And that'll be from reading the newsletter. Or you'll say, oh, I heard they built a lot in Durham. I don't know. That's information you'll learn from the newsletter.
Yeah. Okay. All right. No, it's true. Now, so this piece, Matt, a couple really interesting facts, and it went into a lot of details on their methodology, which I really appreciate. First, it really starts to cover the economy, which we have covered. Obviously, we covered every week, but highlighting a lot of third quarter data showing GDP growth. Well, it's relatively higher, but at the same time, it's relatively robust. It's moderating inflation while still elevated. They're still projecting that we're going to be getting down to the Fed's target of around 2% over time. And so they're really seeing a continued moderation in the economy, no necessarily inflation in sight. Some recent, job slowdowns over the third quarter were more a factor of strikes at Boeing and hurricane activity. And the unemployment rate, is staying consistent at 4%. And as we mentioned earlier, hourly wage growth has remained, relatively stable at 4%, which is, again, as we mentioned, well above national rent growth levels, but there is some catching up to do from the last couple of years. So generally, the economy is in a pretty good shape. As we mentioned, they didn't really incorporate anything relative to the election in here. And so, that any effect from tariffs or economic upside, deregulation, that has also not been factored in. Now, getting into the U.S. housing and mortgage market, is really detailing some of the whipsaw effect that we've seen relative to mortgage rates. Again, 10-year Treasury, down almost 3.5%. Now it's back up to 4.3%. So buyers have just been whipsawed around. And while home sales are down, they're still in a healthy spot. We've got about 4 months of existing inventory in the nation. That's the highest level of inventory since 2020, but it's well below kind of the pre-pandemic average of 5 to 6 months of available inventory. New home sales have been really picking up. A lot of new home sales. The builders have been building. They're providing incentives to get folks into newer homes, kind of offering kind of teaser rates so you can get a lower mortgage rate that essentially that builder is subsidizing to get you into that home. So they're still selling a lot of new homes, but in general, home sales are down, but relatively healthy relative to demand. But construction is really decelerated, especially in September. Total housing starts declined by 0.5% from August and 0.7% from last September. And again, as they note, this was primarily due to a slowdown in multifamily construction, which decreased over 15% from last September. And home builder confidence inched up for this second consecutive month to 43, according to the National Association of Home Builders Housing Market Index.
But it's
which we
still
also
below
track.
50, so it's like
A little bit more confident, but not confident enough. Especially with interest rates, you know, it's amazing. And that, I think, is the sense of, you know, okay, interest rates popped up, which you would typically assume would make home builders less confident, but they're seeing the fundamentals. They're seeing starts decline. They're still seeing demand. They're still selling houses. So they're still even more confident. And that would indicate that they are feeling that rates will continue to decline, which is certainly a consensus view for most economists. High mortgage rates and low affordability impacted home ownership rate in the third quarter. The home ownership rate was slightly lower at 65.6%. That's not shocking. I mean, if the home ownership rate increased in this environment, that would be surprising. And compared to about 66% in Q3 of last year. And that's all due according to the Census Bureau. So, you know, we've increased the number of housing units, and I'm just going to skip ahead to.
Totally. I want to show that Exhibit 1, though. That's what really drew me in.
Yeah, tell us about this.
And so they're kind of like, they're explaining like, don't worry that that mortgage rates have jumped since first rate cut, because generally they do kind of pop up a little bit after in the weeks after the first rate cut. However, the graph there is not convincing. The graph there shows multiple so there's a bunch of lines on this line graph, and each line represents a time in which the Fed cut rates going back to 1990. So in 1990, the Fed cut rates, and rates didn't really pop up. But guess what they did dramatically in 2024? More than anything, the mortgage rates increased after the Fed funds cut rates, and they increased
and continued to increase
more sharply than it has ever done before since 1990.
And I think that my explanation for this is the election and you know, potential inflation and tariffs being, and just volatility in the U.S. economic system. And so I think that that's the difference between these other instances, but we'll see. We shall see.
Yeah, because I don't
also,
think
you know,
that
again, post-pandemic.
I don't think any of those were election year were presidential election years.
I mean, 2020 was, but again, we were in COVID.
Oh yeah.
But again, different dynamics.
Completely
different dynamics.
It does seem like this is a little bit of an outlier. There's a little bit of uncertainty here, and that's also what I was thinking about.
That didn't count. that was a different time.
Yeah, sure.
It's freaking pandemic.
But I do agree. There's so much about this that seems like a product of uncertainty, and less about like, I really think that things are going to be bad, or I really think that there's going to be inflation. Like the Fed funds projections are quite high, as I think a product of uncertainty rather than a product of, well, I think that this is going to be inflation that's going to keep things up, or I think that jobs are and the economy is going to be running too hot. Like that doesn't make sense to me. What does make sense is like, all right, keep it flat. You know, we don't know what's going on, and we can revise later.
I think you're spot on. I really think you're spot on. Okay. This is what I wanted to get to. Okay. Housing supply. We're still undersupplied by millions of units. So again, as I started the show, in 2020, we were down by 3.8 million housing units. We needed to build almost 4 million housing units. And so, you know, we've been talking about, Matt, like we might deliver 1 million units this year, 500,000 units that year. We're chipping away. We're chipping away. That's great.
So how far have we gotten?
Not enough. So we now, Freddie Mac's estimate for based on data through the third quarter of 2024 is that the U.S. is still short by 3.7 million housing units. So we've basically made 100,000 units of progress.
2 steps forward, 3 steps back, or
really
not. I mean,
that, and you're like, okay, so wait a second, but we just added hundreds of thousands, you know, over the last couple of years. Well, the issue is, while we did add 5.8 million units, we added more than enough.
Yeah.
Average rate of 2.1 million units a year. But the problem is, our population, number of households increased by 6.3 million. So at 2.3 million annual rate.
It really seems like you're swimming against the current here.
We are swimming against the current, man. It's the only way. That's the only way to put it.
Yeah.
So, and we're getting ready to see housing supply also fall off the cliff.
Yeah.
Maybe not as bad as we saw in 2009 and in the first couple of years after the great financial crisis, but certainly we're going to have a 1.5 to 2 years gap of robust supply.
Yeah.
And it's not like the 2 years of very robust supply growth is going to catch up for the decade of undersupply. And then probably the couple of years of undersupply that we're getting ready to see that will probably wipe out any gains that we've seen since the pandemic started.
Yeah.
So again, if we've learned anything over the last couple of years, is supply is the driving factor.
Yeah.
We know there's demand for housing. As long as we're maintaining somewhat population growth, that there's going to be that demand there.
And housing and building more can really change things. And like we've said before, it's easier to build the house than to like build the demand. And so we've in markets like maybe Austin or other in like Miami where they are building a lot of housing. That's going to affect housing prices. That's going to bring rents down, for instance.
I mean, the only reason why rents in the Sun Belt, and we've seen the migration report. We're going to look at them more in a second. We know the populations are growing. We know the demand's there. We're building a lot, and that's the only reason. Yeah. Because we've built a lot is the only reason why they're seeing relatively moderate rent growth. They're actually seeing some rent pullbacks. Yeah, it has nothing to do with the markets other than we've built enough housing supply for a short period of time. But the rents had been growing by well above trend, and so they're going to get a year or two of reprieve. But we know that is it's transient.
Yeah, and so that's what makes me kind of interested. So, this election
seems like the housing market might be a good place to invest right now.
Yeah. Well, and just what's kind of interesting is like, all right, housing was a big part of the election. We're entering a time where a housing shortage may drive further increase of housing costs. Like, if it was the Harris administration, we may be looking at, I mean, at least in the Biden administration, there were punitive things about like a little bit of a stick approach where they're going after algorithms.
Yeah, stick approach. And it's like, oh, well, the federal government will come in here and fix this problem.
Yeah.
And the federal government's going to, build some housing, or we're going to have a very centralized, approach to how we're going to do this. But also at the same time, we're going to discourage investment activity by making loans harder to get. We're going to put covenants in loans, and we're going to put strings attached. We're going to put DEI initiatives, in order, into Fannie Mae and Freddie. Yeah. And that's not going to happen. And so I think that again, if there is a difference, again, leaning more on the side of deregulation and liquidity in the markets. Yeah. I think we're going to find a better path to more stable housing situation, hopefully. Yeah. Than thinking that some like a I could see a housing czar emerge, in either administration, but if someone actually is like, the federal government's going to provide all the housing. And I hope they don't try to build on the federal, the federal lands.
I know.
That's not the best. That's what we're going to do.
Yeah. Well, and that's not to say that, the Harris campaign and Biden too, in their communications in general, did talk about the supply oriented policies, the deregulatory policies.
Yeah, even they were starting to see.
Even they were starting to see, but I think that.
But we'll make them do it our way.
Yeah. Well, and that's what I was going to say is like in Trump, it's more unambiguously deregulatory, and we'll see whether, like I said, like it's a deregulation where you slam the door and the house falls apart. I don't think it's going to go that far, but we may see some real encouragement. I heard that opportunity zones could be. Could
expanded
be used.
Or refined.
Some of the new HUD guy has some experience with opportunity zones, so we'll see the kind of incentives for more supply, and that's what I think is gonna. That's maybe why the National Association of Home Builders, they're feeling a lot better now. Maybe.
I think you could be right. Matt, do you want to pop over to the National Association of Realtors Migration Trends? The Freddie Mac piece is really great, and I encourage everyone to keep we just covered the basics. Again, subscribe to the newsletter at greatcapitalllc.com. You're going to be hooked up with all these articles and so much more. Migration trends, where people moving around. We're talking about household formation, population growth or decline, depending on which direction you're headed. And I believe this report it's going to combine a couple of the different, reports. U-Haul, United Van Lines, all those folks are getting metrics of how many people are moving, where are they moving, and here's the list: top 20 states with largest net migration. I see some familiar names and a couple in the middle of the pack, Matt. Some Midwestern markets that could be interesting.
Florida and Texas, clear leaders. They've got 372 and 315,000 respectively for largest net migration. And then it falls off to 126,000 something for North Carolina. And then you get South Carolina, Georgia, Tennessee, etc.
So everyone from New York's moving to Florida. Yeah. Everyone from California is moving to Texas.
Yeah.
North Carolina also thrown in the mix.
And they're building a lot of apartments there too. But what surprisingly, you also see a Midwest presence. You got Ohio at, I think that's number 10, Indiana at 11, Wisconsin at 15, Missouri at 17.
I throw Arkansas, even though it's, technically in the South, but, it's
put
kind
Kentucky there too. Yeah, why not?
Yeah.
Missouri's just as south as Kentucky.
Middle, kind of, middle America.
Yeah. And I would argue a big part of this, and there's evidence to back it up in this NAR report here, is they are moving because of price. Now, the biggest reason was get back with friends and family. I think that there's a strong narrative here of like maybe moving back to where you were from, but back to your hometown. But 30% moved for family and friends, 21% moved for money, more home for the money. Regionally, really, it is the Sunbelt. 46% of respondents' clients move to the South, 25% move to the West, 18 to the Midwest, 11 to the Northeast. Generally, people move to from one suburb to another suburb. But if you're talking about people moving to different areas, the biggest movement was from like kind of central urban areas to a suburban area. And they moved, and some of them moving to resort areas to a suburban area as well. I don't know what.
And is that just counter pandemic trends?
I think so too.
Finally,
that does seem like very stark. Like, yeah, you moved to where there was mountains and maybe a seashore, and now you're moving back to your family.
I mean, it surprises us, Matt, because we've been in the office since 2020. We opened an office during the pandemic, as opposed to started working from home. Mm-hmm. But a lot of companies are still now. They're just now coming back to the office.
Yeah.
I mean,
weird. Well, Elon's bringing them all back in the government, right? Is that one of the things? One of his tactics?
Well, that's what I've heard said that in order to reduce the government workforce, instead of firing, you just need to require them to come into the office. Half of them will quit.
People were like, "What? No, you could work." No. It's not that. He's trying to get excuses to get rid of them.
Yeah.
We'll see.
We'll see. We'll see how effective that is.
But so secondary reasons. So why they move? Number one, family. Number two, affordability. And then lower, more favorable taxes, less crime, being closer to the work location. But really, it's all about getting more house for your money, especially if you're talking about
back. It's interesting. Yeah, people are coming back to the Midwest, which I guess I've done myself. Mm-hmm. I know a lot of people who I moved to and lived in New York for a couple of years, and Florida for half a year, and then back to Indianapolis. I know a lot of people. You go up to you graduate, you go up to Chicago, and you get a nice big job. You live in the city, and then you come back from Chicago, and you're like, this is way more affordable and pretty nice. And
well, but then you also have to be a little bit arrogant when you're coming back home. You got to be like,
well, in Chicago. Oh well, yeah, exactly.
This is
the way we had it.
Yeah. That's right.
We would the rooftop bar every. You
don't have that here. You don't have that here.
Lou Malnati's.
That's great. That's funny.
We've got that too now.
But I think that there is affordability still a huge component. It's interesting to see this social component to moving.
Closer to family and friends. What's really important.
But more home for the money and lower, more favorable taxes. That's a big deal.
I mean, is this not this is a Sunbelt and the Midwest thing? But this is again, and it shows up in the numbers.
Yeah.
This is, very favorable to Sunbelt and Midwest trends.
Yeah. And it's also kind of worth noting, 300,000 into an entire state, like 300,000 in the state of Texas. The Texas population's millions and millions. So we're not talking about a huge movement. Again, you can build out of this for a lot of the, especially like for a specific market, like that's the whole thesis of this Sunbelt building. And they have overbuilt, even though there are so many people moving in. So it's not, so the migration is a huge story, but it's not the biggest story. I think the biggest story is still apartment supply.
Yeah, agreed. 100%.
Wow, they've got cultural groups in new area. That's one reason. 1% of people move.
Yeah, that makes sense
for that reason. 2% in the Northeast.
Yeah, and it's interesting that 1% move to the Midwest for diversity.
Yeah,
which the Midwest isn't always known as the most diverse place, but we've got our pocket. We've got all kinds of
1% move for better weather conditions.
Honestly, to me, I would think that would be higher than 1%, or 4%. That's just 1% thought the Midwest will have better conditions. Interesting. Yeah, it makes more sense. People are moving to the West or the South for weather, but still, what's really important? It's your family and friends, and then it's money.
Yeah, I actually really striking here is closer to work location is not up. I would think it'd be.
It's number 3. Yeah.
But support.
I think that these are the primary reasons. I think that it's they're hitting a couple birds with one stone.
Yeah.
So fascinating. Again, I read this whole piece. This is interesting. I think this is again paints a bullish message. And thesis for suburban investments, as well as for select Midwestern markets, and keeping an eye on the Sun Belt for deep discounted deals. You're going to see a lot more supply coming online, but again, the long term prospects. If you take a long term approach anywhere in the multifamily market, that's always the best approach to take. Yeah. But long term approach in the Sun Belt, I think, will pay off. Very much over the next decade. Long-term approach in the Midwest, I think same thing, but you may just get a little bit more growth in the midterm.
Yeah. I'm an optimist. I haven't really thought about what are the markets that are going to be declining? I'll get back to you on that, but
we're always talking about occasionally we touch on about, what are the 5 worst? Maybe we include that in the forecast. Yeah. Five markets to avoid.
Yeah. Well, I've heard some chilling stories about Midland, Odessa, but that's all.
Oh yeah.
Well, they were one of the lowest for a while. They were building the least amount of new apartments, and I think it's very dependent on the gas industry, oil and gas, but chilling.
Fascinating. All right. Now to round out, last week we talked a lot about the report from the Gray Capital report on the next wave of loan maturities and how extend and pretend has basically added to this wave of loan maturities, kind of pushed it all off. Again, it's just just wave dynamics. You're continuing to bounce off the wall, building up energy, and that energy will crest at some point. Now it's a healthy market, looking like it's ready to absorb a lot of deals. And again, the fundamentals are strong and solid, but maybe some more pain to come down the pike. Yeah. Matt, where's this TREP piece kind of picking up from where your research report left off? Get us up to speed on some other areas that they're looking in, and maybe even first, kind of paint the picture for folks that are just coming into the discussion of loan maturities.
All right. Well, I think.
And is it a myth? Because it was reported a year and a half ago.
So let's start right there. Yeah. So we read these headlines a year ago. We read that maturities were looming in 2023. What's the difference? Now they're coming in 2025. I think that you should read the New York Fed's report. Oh, that's a long report.
Yeah, Matt, that's 50 pages.
Oh,
a lot of math.
Hey, go to Gray Capital LLC/report. And you'll get a short 1 to 2 pager. And that's going to give you a little bit more of a concise answer. Essentially, I would argue extend to pretend is the logical connection between the loan maturity wave that never was in 2023 and the loan maturity wave that likely will be in 2025. It didn't hit so hard because we pushed those loan maturities 2 years, basically, from 2023 to 2025. Where's the proof? Well, it's a little bit of an implied proof. I can't talk to every banker and every borrower, but we are seeing this. I am frankly a little bit surprised at the organic amount of attention. I'd like to think that it's all probably, let's say most of it's from our report. But I also like to think that Trep's noticing this. There's a post from CRE analyst.
I think, the New York Fed, when they put out that report, I mean, to me, it was put out for a reason. I think it was just like they put out, the guidance for, lenders, multifamily or commercial real estate lenders. I think it was a similar way to, hey, look, this is this research. We think it's important. We see this coming down the road. We need to be aware of it. We need to, get ready to deal with it. I think there's also, it's showing up in, the agency, GSEs, Fannie Mae, Freddie Mac, increasing their caps. Whether it's HUD, decreasing DSCR requirements, increasing LTV ranges to accommodate transactions that are going to need to take place next year.
Okay.
So they're trying to get in front of it now. But, so, I mean, when we saw that piece came out, I mean, I came up to you right away and I was like, Matt, we got to put, no one's going to read this 50-page report. We got to put something together. I'm assuming, I'd like to think that our report, that I think we beat most folks to the punch a little bit. All these subsequent reports that came out, in the days after your report hit the waves.
And what's super interesting,
we're all seeing the same thing or similar things.
Yeah. And what's really super interesting is some of the data that we used to isolate this wave that we were looking at in 2025 was CMBS data, and it looks like this is present in other places.
Oh yeah,
there was
because it's relative to transaction activity, and you're going to finance whatever is most accretive, but it's still those volumes, and you're going to see similar increases of transaction volumes across loan types, and CMBS is a relatively small portion of multifamily loans because you've got the agencies, you got the GSEs, longer term debt typically. But again, what we're really talking about is bridge loans, construction loans, shorter term, typically bank loans, balance sheet loans.
So here's some great numbers here.
Bring it.
Or chilling numbers. $96 billion of loans with a DSCR below 1. 79% of those are floating rate loans with an average 7.8% interest rate. In comparison, the estimate.
Could you say that again one more time for everybody, starting at DSCR?
Okay. DSCR below 1, 96 billion of loans.
96 billion of multifamily loan. 96 billion below a 1 DSCR. That means $96 billion of not just of multifamily assets, but multifamily debt. So let's assume, because the value is now equal to the debt, it's $96 billion worth of real estate assets that cannot afford to pay their mortgage.
Well, so this is where I want a little bit of context here, a little bit of perspective. How bad is it? You dip below 1, that's okay, right?
Well, you're on the watch list.
Yeah.
So what it means is you can't afford to pay your debt with existing cash flows.
Yeah.
So if you have reserves, if you have money in the bank, you can continue to service that debt, but you're basically eating your children, going through your reserves to do that. That can only go on for so long. There's a finite number of reserves because you're not adding to your reserves outside of your replacement reserves that the lender is holding on to, because all of your cash flow is going to pay your lender. So what happens when you go through all your reserves, you have to start reaching into your own pocket, and so this is either a sponsor or operator taking their personal or their other company's the company that they control and taking those funds, putting them into the deal, typically in the form of a member loan, saying like, hey, the deal needs an infusion of cash. Before I'm going to ask anybody else, and this is what should be done, I'm going to put cash into the deal myself. There's going to be a nominal low as possible interest rate, and but I'm going to basically waive the interest, put the money in the deal to keep it moving. The next step would be either another infusion of cash, whether in the form of equity or preferred equity. So some sort of equity coming into the deal. Capital call would be the existing LPs. They're going to write another check to basically continue to float the deal, fill up the reserves, to keep paying the debt service, because there's a thought that, hey, look, we think that we're going to be able to create a lot of value here. There's going to be growth, and we see a clear path to success. But now that money, that new capital, will essentially dilute all of the equity. So whatever returns you thought you're going to get, you're going to see a reduction in that eventual rate of return. In order to get back to the same rate of return, you're going to need to see growth far in excess of the original pro forma.
Yeah.
And most likely you've missed out on a year of growth on that original pro forma. So that's almost mathematically impossible to do, although sure, I mean, yeah, there's a cap rate that makes that happen.
Yeah. Okay.
Then if you don't want to do that, alternative is getting outside equity, like preferred equity, to come in and write you a check that's going to get paid off before your existing investors. So it increases the risk significantly from your original LPs. And it puts a big weight on the top of the deal.
Yeah.
It's a good tool in the right situations, but a lot of these deals, as I said just initially at the 96 billion, when I'm looking at a lot of these deals, whether we've analyzed them for preferred equity or taking out development equity, unfortunately, the value of some of these deals is equivalent if they have not been performing, if they have not been able to push NOI, and even if they have been. They've had either flat appreciation, which means that a refinance isn't going to give them the debt proceeds to fully refinance. So they're going to have to do a cash in refi. So it's like, hey, no, we've grown NOI, but interest rates are so much higher that we still are going to have to bring, we had a $10 million loan, but the new loan's only going to be for $8 million. So I have to bring in $2 extra million. Now that doubles my equity. And so my returns are going to be eventually cut in half.
Yep.
Or this basically, look, we don't have the value of the asset is worth what we used to borrow. And so we're going to sell it and we're going to pay back the lender, and the lender is going to be made close to the hole, but the equity's gone. It's wiped out.
Yep.
And so folks are going to have to ask themselves, do I do that cash in refinance? Do I bring that extra $2 million or whatever it is to save the deal, to live the fight another day? So maybe I can get my initial investment back. So you're going to have to, do you double down?
Yep.
Or do you cut your losses and find the better deal?
Well,
because both can get you to the same place.
The New York Fed wrote that, I think, because the impulse is to always double down. It's always waited out, and so many people waited it out, and they're saying banks, you're allowed to get strict right now.
Yeah.
And I'm thinking this too, like.
Well, you have to make a decision, because the decision wasn't put off. They're saying, okay, we'll extend. We'll just kick the can down the road. Now it's saying you have to, put up or shut.
How many people extended in 2023 thinking that, all right, things are going to get better? They didn't get better for a full year.
Survive till 2025, Matt.
And 2025, if we're adding 500,000 apartments, then it may be very similar to this year, a little bit better, but not as good as people need it to be. And so if you're looking at that right now and thinking, well, okay, I extended and it didn't work. Am I going to do it again? And it's still like, that's a lot of length. You'd have to, I think some spreadsheets are going to be screaming at some of these analysts because they're not going to get to where you need to be without living in like a fantasy land.
The math is not mathing for them in the way they would, the way they would like.
But yeah, to get back to this TREP thing. So it says these are 7.8 interest rate for a lot of these loans. And the estimated cap rate at securitization has been in the 5.2 to 5.7 range. Does that mean that the cap rates are lower than the interest rates?
Yeah.
Does that mean that's bad, right? That means that you're paying more in interest than you're getting from the property, essentially.
So your cap rates.
Or cash flow from cash flow. Yeah. Okay. So you're relying essentially kind of on appreciation a little bit.
Yeah. And growth, rent growth, NOI growth.
Okay. Now this is also really relevant by state. Texas, California, Florida, Georgia, and New York represent the largest concentrations of multifamily loans with a current DSCR below 1. I think that New York is this, just because of the number of apartments that are there, that's probably why. But proportionally, I'm sure that the Sun Belt has more, it's got Pied Piper.
Just amuse your imagination over the last couple of years and think about all of the, relatively newer syndicators that were slanging deals in the Sun Belt. Because if you listen to the gurus, it's, go to the Sun Belt, go after population growth and job growth.
Yeah.
Makes sense. Not bad advice. But everyone just following the same advice.
Just think about one more thing. If they thought about one more thing, which was how much they're building in there.
Yeah.
But they needed it though.
Yeah.
So
yeah.
Yeah.
Yeah. Again, wasn't wrong. It's just it was crowding everyone into the same markets and ignored some other markets that also had opportunities. And and Matt, if I was from Austin or Charlotte, I'd be investing in Austin and Charlotte. So I don't want to. It's not like I'm from I'm from Europe, and I was like Indianapolis is where I'm going to move, and that's the place to be. I moved away from Indy and moved back from Indy because I eventually was like I appreciated Indianapolis more.
Yeah.
But so there's definitely a little bit of luck in us choosing the Midwest because it's where we're born. Totally. It just happens to be happenstance. But that could be, you could say that for a lot of things. But we're in a good spot, and again, coming back to these syndicators, I mean, you've all heard the story, and a lot of them were following a playbook that worked in a uptrend market, non-volatile market.
It was an easy sell. You talk to an investor and say, look at these beaches. Everyone's moving there. Let's invest.
Yeah, just population growth, metrics.
Yeah,
it's straightforward, but the reality is people are rushing to do deals, so they paid up for it, and then they're learning operations as they go. It's a lot of these deals they're put together not just with one sponsor, but by a collection of a couple of different people. And so who's really in charge, who really knows what they're doing, third party management, out of state ownership, again, new asset managers. So and unfortunately those properties are going to be they're going to be a mess to clean up.
Yeah.
And so you're going to need to they're going to have to be sold at a decent, real discount.
Yeah.
To make it attractive. I mean, I'm assuming the way we are looking at the market is the way others are looking at it. And look, renters are preferring, newer, nicer, growth in the suburbs. I'd like to rather get a good deal, pay a reasonable price. Obviously, just discount as much as possible, but you're only going to get so much of a discount in this market. I'd like to buy a good deal, relatively newer deal at a good price, at cash flows. But some of the huge discounts, the pennies on the dollar, where you could make a lot of money, but it's going to be, you're really going to have to roll up your sleeves and you could lose some money, is going to be in these older deals that have been run into the ground or just not effectively managed. And there's going to have to be renovation. You're going to spend a lot of money on deferred maintenance and fixing bad renovations. And so to make up for that, you're going to have to pay higher insurance, all these. It's a pain to manage some of these properties. So it's like, to do that, like, what would it take for us to want to do that? It would have to be a lot, and we've done that successfully in the past, and we're like, we'd rather maybe not do that because the amount of time it takes the organization to focus on those properties, and so there has to be just huge upside. So huge upside is going to originate from lower prices,
and those lower prices are. I think that those lower prices, at least for a lot of syndicators, it's going to be they're going to try to double down. They're going to try to keep owning it for as long, and they're motivated, but probably motivated reasoning to say things are going to get better in the future. They don't want to admit the loss or realize the loss, it's going to. So I think everything is going to be the real cards are being held by the banks, and that's what this New York Fed thing. It was permission for the banks to get strict, and so that could be what we see. I do want to talk a little bit about this CRE analyst post. CRE analyst, love him. I wish they had a podcast. They don't. I'd love for CRE analysts to come to the Gray Report. That would also be awesome. But their point is that multifamily specifically, they could have a lot of problems when it comes to debt, and they're talking about some of these institutions that have multifamily loans, and they're maybe not doing too well. And I think that that there's some challenges there. And so their argument is that if institutions have with 40% LTV properties aren't covering, what does this say about the more levered owners who borrowed at 60 to 75%? How long are they willing to feed these properties before selling or giving them back to lenders? So I'm very much summarizing this, but they are putting turning on the warning bell or the warning light or whatever.
And that's what's going to separate a lot of, again, the newer, call them undercapitalized groups to the groups that have been around for a couple more years and have gone through maybe even like not even a full cycle, but just were around for the last market run up. Is that if you don't have hundreds of thousands of dollars or millions of dollars in the bank account, how are you going to feed the deals? But it's not typically like we need like a couple $1,000s. It's like we need to put a couple $100,000 or $1 million, or I'm going to come to the table with a couple $1 million. And not every syndicator, especially if they haven't gone full cycle on a couple deals, has millions of dollars ready to go.
Yeah.
They probably, if they did, they probably had to throw in a big chunk of that into the deal in the first place to get a healthy enough co-invest.
And for these institutional investors, I think too, maybe you do have the money to feed the property, but at this point, or at what point is my question? Do they say, well, actually, we could make more money by using this money instead of feeding the property? Let's sell it off and get a new one. Right now, the growth prospects for trying to save this deal are worse than.
Why throw good after bad when there's actual other opportunities out there?
And that's an institutional perspective, I think, that they can have, because they're not, my guess is, as emotionally connected. It's not a do or die situation. But syndicators, I don't know. I just feel like they're going to hang on.
Yeah. Yeah. Well, fascinating discussion. I hope everyone had a nice Thanksgiving. You're watching this afterwards. Make sure you comment on this video with any thoughts, whether we're right, wrong, or just give us your take on the multifamily market and the economy. Make sure you're signed up for the Great Capital newsletter at greatcapitalllc.com. And also, again, like and subscribe, all that good stuff. Matt, thanks again. Have a happy Thanksgiving. And everyone watching the Great Report, thank you. See you next time.